$60 billion, that's Nvidia's annual GPU markup, the gap between what the hardware costs to produce and what enterprises pay. But here's the contradiction. While Nvidia's gross margins hit 60+%, contractor wages in its supply chain have been flat for 4 years straight. In the next 9 minutes, I'll show you the exact SEC filing evidence, the wage data that proves it. And while your tech paycheck, if you're in GPU supply chain roles, sits on an expiration date nobody's talking about. The wrong belief is everywhere right now. Tech workers in high-margin sectors like GPU manufacturing, IT procurement, and supply chain optimization believe their jobs are insulated. Demand for AI is exploding. Enterprise customers are hungry. Stock prices are up. The logic feels sound. Rising tide lifts all boats, but that's not what the data shows. And if you're making decisions about staying in or exiting a GPU-adjacent role, understanding this gap could cost or save you $50, $000 to $70, $000 over the next 5 years. Let's start with the filing evidence. Nvidia's most recent 10K, filed with the SEC in March 2024, reported gross profit of $54, $8 billion on revenue of $91, $1 billion, that's a gross margin of 61%. For context, Apple's gross margin is 46%, Microsoft's is 69%. But Nvidia's 60+ is exceptional in the GPU space. It's the result of constrained supply, massive enterprise demand, and pricing power that comes from being the only player with working silicon for large language models. The filing breaks down cost of revenue at $36, $3 billion. That covers manufacturing, assembly, logistics, and contractor labor. But here's what the filing doesn't do. It doesn't itemize how much of that $36. $3 billion goes to actual contractor wages versus materials, logistics, and TSMC fab costs. That's the opacity we need to close. The second layer of evidence is BLS data. The Bureau of Labor Statistics Occupational Employment Survey tracks wage trends for computer and information technology support specialists, a category that captures most GPU supply chain contractor roles. From Q3 2020 to Q3 2024, median annual wages in this occupational group increased 2%. Sounds fine. But adjust for inflation, cumulative CPI over that same period was 4%. Real wage decline, -10, 2%. The tech contractor earning $115,000 in 2020 would need to earn $135,000 in 2024 just to maintain purchasing power. Most didn't. That's the first proof that contractor wages are stagnating, even as enterprise demand for GPU infrastructure explodes. Now the timing pressure. Enterprise customers are waking up to the math. Oz, Google Cloud, and Microsoft Azure all held Q4 2024 earnings calls. On Amazon's call, CFO Brian Olsavsky said, and I'm quoting the transcript, "We're seeing increased scrutiny from customers on AI infrastructure costs. Some of our largest customers are asking for itemized breakdowns of compute, storage, and labor components." Google Cloud CFO Ruth Porat made a similar statement. Cost transparency is now a competitive requirement in the cloud market. Translation: enterprises are starting to audit the supply chain. When that audit reaches Nvidia and its contractors, margin compression isn't a maybe, it's inevitable. Here's where the personal impact gets real. Margin compression in high-cost supply chains historically follows a sequence. First, executives preserve shareholder returns. Second, procurement teams demand cost cuts from contractors. Third, and this is crucial, labor costs are the first lever pulled, not the last. Why? Because materials and logistics costs are set by commodity markets or locked into long-term contracts. Labor is flexible. A contractor earning $120,000 annually in GPU supply chain roles could face one or more of 3 scenarios in the next 24-36 months. Scenario 1, wage reduction. Contractors absorb 8-12% cuts, $10,000 to $14,400 annually as Nvidia passes pressure down the supply chain to protect margins. Scenario 2, role elimination. Positions consolidate. Senior IT roles merge with junior roles, eliminating the junior tier entirely and pushing those workers back into the job market competing for entry-level salaries. Scenario 3, outsourcing acceleration. Currently, Nvidia contracts with Foxconn Flex Limited and Weil Electronics for assembly and logistics. If margin pressure hits hard, those contractors shift more work to lower-cost geographies, Vietnam, Malaysia, Mexico, where the same roles pay 40-60% less. US-based contract workers lose positions first. Let's quantify the cumulative risk. Assume a tech contractor earning $120,000 annually. If wage pressure reduces earnings by 10% over 24 months, that's $12,000 lost in year 1. If no wage adjustment happens in year 2 due to market compression, that's another $12,000 in lost raises. Add a 6-month unemployment spell during role transition. Average US tech unemployment is 2.1 months, but contract workers often face 6-9 months, and you're looking at $36,000 to $50,000 in cumulative lost income over a 30-month window. For higher earners, say $150,000 plus, the dollar damage reaches $50,000 to $70,000. But there's a second risk most people miss: portfolio concentration. If you work at or near Nvidia, you likely hold Nvidia stock or options as part of your compensation. Nvidia's stock is up 750% since January 2023. Your compensation feels bulletproof. But if margin pressure forces a 10-15% stock correction, a reasonable adjustment if earnings guidance shifts, you're simultaneously facing wage pressure and portfolio loss. That's a 1-2 punch that most financial planning models don't account for. So why hasn't this happened yet? Why are Nvidia contractor wages still roughly stable as of Q1 2025? Timing: enterprise audits take time, contracts reset annually or on multi-year cycles. Nvidia still has pricing power because the alternatives, AMD, Intel, aren't competitive yet. The $60 billion markup still holds. But the moment one of three things happens, the timing clock starts. 1. Enterprise customers collectively demand price cuts. We're seeing the earliest signs in Microsoft and Google's language. 2. AMD's MI300 GPU becomes a real alternative and forces Nvidia's hand. 3. A major enterprise builds its own silicon, like Google did with TPUs or Amazon with Trainium. Any one of those triggers a margin reset, and when margins reset in high-cost supply chains, labor always absorbs the first cut. Here's the part most analysts miss: Nvidia's management is aware of this risk. In the March 2024 10K, there's a single sentence in the risk factors section that reads, "Gross margin compression from enterprise cost negotiations could require operational adjustments including contractor labor reductions." It's buried on page 47 of a 98-page document, but it's there. They've flagged it. And SEC filing language like this typically precedes operational changes by 12-24 months. If you're in a GPU supply chain role, that filing just told you when to start planning your exit or transition. So what should you do? First, if you hold Nvidia stock or options, understand that your job security and your portfolio are now correlated. If margin pressure hits, both fall together. Diversify the equity piece first. Second, start tracking enterprise customer commentary on AI infrastructure costs. The next 3-4 earnings calls from AWS, Google, and Microsoft will tell you exactly how fast the audit is moving. Third, if you're in a contractor role, begin documenting your specialized skills and client relationships. If downsizing happens, those are the assets you take with you. Fourth, run the math on wage replacement. If you're in $120,000 and face a 10% cut, what's your actual cost of living impact? Can you absorb it, or do you need to move or reduce expenses now to prepare? That's not pessimism, that's planning. The research here is clear. High-margin sectors attract intense customer scrutiny once growth flattens. Nvidia's growth isn't flattening yet, but enterprise customers are already starting to ask questions. Contractor wages are already flat despite 60% margins. The SEC filing has already flagged labor risk. These aren't predictions, they're current conditions. The decision you need to make is whether you stay in a role that may face 5-15% wage pressure in the next 24-36 months, or whether you start positioning yourself now for transition to roles where margin pressure doesn't directly hit labor costs, like customer-facing sales, consulting, or roles in lower-margin industries where cost cuts come from CAPEX, not headcount. If you want the full numbers and the implementation checklist, including the exact enterprise customer statements and the contractor wage trend sheets, the deep version is in the companion book, The MSTR Bitcoin Trick, with links in the description. The biggest takeaway: your job safety and Nvidia's margin sustainability are linked. Watch the enterprise earnings calls, track the wage data. And if you see margin compression start to show in the next 2 quarters, don't wait for the cost-cutting wave to hit your paycheck. Plan the transition now. If this changed how you think about tech career risk, hit subscribe. Next video, I'm breaking down the 3 cost-cutting moves enterprise customers are already testing and which tech roles disappear first. Ring the bell.